Welcome to Algo Trading Week, day 6, everyone. And yesterday we hosted a panel of discussion on current trends in quant finance. We discussed about some of the current trends observed by our panel of experts yesterday, and we also talked about the future of quant finance with them. And it was a very interactive session, and they answered a lot of questions. So, if you could, if in case if you missed those sessions, you can check out the recordings on Algo Trading Week page over here. So all the recordings are available, as you can see, watch recording. And for today's session, we are going to have a Q&A session on artificial intelligence in trading. And we will be joined by our very own Dr. Thomas Starke from Sydney, Australia. A lot of you already know about Dr. Starke. He is one of the esteemed TPAT faculty members, and he has shared his experience with us on many occasions in the past. About Dr. Starke, so Dr. Starke has a PhD in physics, and he is currently leading the quant trading team in one of the leading prop trading firms in Australia, that is AAAQuants, and as its CEO. He has also held the senior research fellow position at Oxford University. Dr. Starke has previously worked at the proprietary trading firm Vivian Court and at Memjet Australia, which is world leader in high-speed printing. He has led strategic research projects for Rolls-Royce in UK and is also the co-founder of the microchip design company PCMan. So, with that said, I would like to welcome Dr. Starke to Algo Trading Week. Dr. Starke,
Okay.
are you here with us?
I am. Can you see me?
Yes, I can see you.
Okay,
How are you
fantastic.
doing today?
Hello. I'm good. Hello, everyone. I'm really well. It's already evening here in Australia, so I apologize a little bit for the dark light here. I hope it's still gonna be okay to see me. And thanks
We
for
can
the
see you. We can
introduction.
see you.
And yeah, thanks for the introduction, and thanks for having me on board. I really appreciate that.
Pleasure is ours. Okay,
Right.
so to start off with, I would just like to share with everyone that this is going to be a sort of interactive Q&A. So I have a list of questions with me already. So I'll ask those questions one by one. But in case if any of you have any questions about today's session or on artificial intelligence, please make sure that you ask those questions in the questions panel or in the comment section, and we'll definitely pick the relevant ones, and we'll try to answer as many questions as possible in the limited time that we have today. All right,
Can
so
I
let's
just
start.
quickly ask how much time it was? Was it
It's 60 minutes.
okay? Okay, good. Sorry about that.
So
I
we
wasn't
have
sure
60
whether.
minutes.
Hmm.
Yeah, we have
Okay,
60
great.
minutes at hand. All right,
Great.
so let's straight away start off with the first question. So now this is a very common question and the most popular one that I recently come across is why is AI considered the next big thing?
Yeah, that's actually a really good question because I sometimes wonder myself, but no. Well, basically, I mean, AI and machine learning have been around for a really long time, but the problem was always that there was just not enough compute power to really, run the algorithms effectively. And it's only been recently that the computers have gotten strong enough to do this. And probably, I don't know, about 20 years ago, AI was still, still difficult to do because you still needed large computers for that. But I think the reason why it's the next big thing now is because AI is just so accessible to anyone. I mean, I can run fairly substantial algorithms on my own laptop, and that wasn't possible for all the time we know. And then the other thing is the cloud enabled us to run this in the cloud, so we don't even need any more powerful computers on our desk. We can just run it through server centers. And I think that has contributed mostly to the idea that it's the next big thing. And then it's obviously had a few successes in other fields than finance. I mean, we all know about face recognition or image recognition in general. And you know, we recently had all these reinforcement learners that can beat the reigning world champions in various really quite complex board games, which is fairly amazing. And of course, you know, like anyone who, you know, who's a little bit in that field thinks, well, you know, first of all, I have access to it, and why would I not go and apply it to the one thing that's actually really super interesting, is to make money directly from AI. So it seems like obvious that AI could be the really next big thing, specifically in finance, because it just opens up a whole new world of possible things that you can do, right? And so, I mean, when I started this in this field, my dream was to basically run algorithm and lie on the beach in the sunshine while my computer makes me money. That has never materialized, unfortunately. But the idea is still there, and I think a lot of people dream about this. And I guess that also contributes a little bit to the idea that we use AI in finance, and we can actually, you know, potentially make money from it while we're lying on the beach. So I guess that's mainly why I think it is the next big thing.
Okay. My next question is, and now we talked a lot about, in this entire algo trading week, we talked a lot about algo trading, quant trading. In fact, we in our yesterday's panel discussion, we also talked a lot about machine learning, even artificial intelligence, and we also talked about quantum computing and how it is going to shape the future of quant finance.
Mm-hmm.
So, on the similar lines, the next question that I have for you is AI like really just applied statistics and maths, or it's something else? I mean, is it just maths or statistics?
Yeah, I mean, yeah, that's actually a really good question, because in some ways, well, yes, it is. I mean, AI is purely maths and statistics, right? So there isn't really any magic in a sense to it, you know. So there isn't necessarily an art to it, you know. We use very basic mathematical algorithms, but there is one big caveat to this, and it's the fact that AI and machine learning really are tools, and we're basically using scientific and mathematical tools to resolve something that is intrinsically not scientific. So the financial markets, I mean, I guess we could have a discussion about it, and obviously people won Nobel Prizes in economics and so on. But I would argue, I mean, I'm a reasonably, well, I used to be a reasonably credible academic at one point, and so I've been in science, and I look at finance, and I feel finance is not exactly a science, but a lot of it has more the hallmarks of an art form where and you know, when with arts, you know, you need to know your tools. You know, if you want to be a painter or sculptor, you need to know your tools, and you need to know how to use your tools. If you don't understand them, most likely you won't be able to express what's inside yourself. As an artist, for example, as you should, making a good piece of art. So what people sometimes get wrong, I think, is that they see machine learning as a sort of means to an end, as an end of itself. But the way I see it, and obviously that can be argued, is a little bit different, in a sense that it's really a tool that we use to reach a certain goal, but we need to also understand what we are applying it to, which is actually a more or less not so scientific process, which is finance. And I mean, you know, like anyone can understand this. For example, if you put on a pairs trade, and you know, let's just say you put on Pepsi versus Coca-Cola, but then there's like a massive amount of insider trading happening at Pepsi and sends the price right down, you know, and there's just simply no co-integration or no correlation between the two prices anymore. Suddenly that's really not science, you know. That's at best behavioral understanding or just luck or whatever you want to call it if you're on the right side. So I think yes, machine learning is just that, but we really have to be aware that it's a tool to reach a specific goal, and that tool is very mathematic and statistical. There's one thing I also want to add, that on top of maths and statistics, there's a third component, which in my opinion is extremely important for anyone who wants to be a practitioner in this, and this is a really good programming or software development skills. Because it's easy enough to open up a Jupyter notebook and run some machine learning things, but then if you actually have this and then you actually want to apply this to the market, and you need to write your APIs, you need to make your system fail safe, you know, that it might, you know, that if something crashes, if your computer crashes, you know, you can restart it in a clean way and so on. That really requires some substantial software skills, and that sometimes is actually more difficult because, you know, machine learning tools are pretty easy to use these days. And so it's really important, in my opinion, to, you know, those skills of machine learning and stats really need to be accompanied by good software skills. I think I would completely
So
support.
yeah, so I think from what I understand, it's not just, obviously it is a lot, like majority of it is definitely mathematics and stats, but then there is some portion of art as well, the art of
Yeah,
the tools that you have at your hand, and how you can utilize them at the full potential. Very well said.
I
All
I
right,
think
so
so.
thank you. So all right, so now if we talk about the next question, all right, and this is one of the most popular questions in every state. I also asked this question to Dr. Anistan in the previous conversation that I had with him, and that is, do you really need a PhD to apply machine learning algorithms?
Well, of course, you you know, I'm you know, like Ernie, I'm an ex-academic, and I've got a PhD in physics. But you know, there's a reason why I left academia as well, and I got a little bit, I did get a little bit disillusioned with academia, although I had a pretty good time there. But you know, times have really changed, and I actually think that first you need to ask yourself, what is a PhD? And I always said, well, a PhD is you know, 3 or more of avoiding to go to work, but you know what, when you do a PhD, you have a very specific task that you meant to work on, and you know, you've got, and this is probably one of the advantages, you've got hopefully a supervisor that to some extent guides you through the process and helps you when you have difficulties. Now, let's just say you know, you work on some really new type of trading strategy, that you just found some weakness in the market, and you develop it and you go into depth and so on, and then you build the software around it and so on. It might take you like a year or two, or who knows, and you know, with all the research and until everything is running. And in some ways, you've also, you know, did just as much work as someone who's done a PhD, just the same amount of research. You might not publish your work because, you know, you want to keep it for yourself, and you know, you'll probably not get an academic title for it, but at the same time, if it works well, you get something that is potentially more valuable, which is you're making money. So and so PhD, you know, you don't really learn academic skills anymore. You do your own work most of the time. Now, what I did during my PhD was literally just read. At the time, we didn't really have YouTube and all that, so I just read a lot of papers and so on. But nowadays, you just go on YouTube, you get the best professors in the world on YouTube. Now, sometimes that's way better than going into uni and listening to some really boring second grade professor. You might as well just get it from the best. And yeah, the only thing that is probably lacking is the feedback from someone who knows what they're doing. And so if you manage somehow to find a good mentor that helps you to get started on the journey and that actually takes you by the hand and guides you specifically at the beginning through the process, so you can actually not make like really stupid beginner's mistake as I did when I started in finance. You can, you can get as much or even more out of a PhD. I think anyone can do it. I really don't think a PhD is that important. Having said that, like there's generally people with a relatively reasonable level of intelligence tend to go to PhDs. So it looks like there is a correlation between having a PhD and doing this, but that's just, correlation isn't causation, obviously. So I don't think there is necessarily a causal link. So I guess that's, yeah, I think that's what I have to say to that.
Okay. Yes, definitely. So it's more about practicing and developing something on your own, and that is actually going to work for you rather than theoretical knowledge that you develop in university. That is
Yeah,
more important. That does not mean PhD is not important. Obviously, people do
yeah.
that,
But
and it is.
get a
Yeah.
mentor. That's
Okay.
really good. Mm.
Yes. Okay. Now, okay. So, talking about learning and mentor. So, there are a few questions I can see which are very relevant here that talks about contra courses that you have in collaboration with us, and also talk about in some of the questions are talking about individual traders and how they can benefit from AI. So, I think let's take them one by one. So, the first one. So, we talked about mentorship. Now, this question is for those who are in the financial markets but do not have that coding or programming background, but they are very well versed with markets and they've been into financial markets for quite long and they
Hmm.
want to get advantage of technology. Now, if they really want to, because it's everywhere. You search something about artificial intelligence or machine learning on Google, and you will be followed up by so many advertisements of various courses. Now, but before we talk about any courses, I would like to understand it from you for an individual trader who is just new to this, the technological advancement that is using cloud computing or using Python or any other programming language or any other R or such other statistics tools. Uh, how an individual can start if they want to start?
Yeah, that's an interesting one. It's actually, back in the days when I still worked in prop trading and even in my own company, I've had a couple of people that started with me that weren't actually that were traders. They traded for the last 10 years or so, and they've been pretty intelligent guys, but they have never actually touched a programming language or anything. And so for me, like I can see, when people have potential and they're really interested in it. And what I sometimes rather do is I train up someone in programming and machine learning, and I give them the skills as long as they have an understanding of the market. I believe that an understanding of the underlying markets and the economy is extremely important. And in a way, programming is secondary. You need programming 100%. It's an absolutely crucial skill these days to have. But I think, especially if you have someone who can also mentor you a little bit and get you on the way, then that's not um, um, that's not really the crucial skill. I think understanding the markets really well is actually a really, really important skill. And oftentimes, especially in the machine learning AI community, that is completely undervalued. Now, I feel a little bit the opposite, that it's actually really important to have these skills. And then if you have someone who's reasonably intelligent, they can learn the programming. I mean, you know, this, you know, obviously you need, like for me, to judge whether someone is capable of doing that, who is actually a good trader. You know, you need a little bit of judgment on that. But to be honest, like most people who are good at trading, they generally have a really good sense of maths and programming as well. When they're really interested in it, they will actually learn it fairly quickly. At least that's my experience. And so I've seen, you know, in also in my prop trading days, all the traders that actually really survived in those markets, you know, when stuff really went from screen trading to algorithms, those people who actually started to really teach themselves programming, and there was quite a few, they managed to take the leap. But the people that were just traders, they're more or less started to just drop away, and you could really see it. I mean, you know, I worked only in this one company for maybe 2 years, and within this time, 80% of all the traders just dropped off and got replaced by IT guys, and the ones that survived were really the ones that started learning quantitative methods and machine learning and all this themselves, and programming, and so, and they were still good traders, right? They had this feeling for the market, and then they could actually use the tools, the extra tools that they learned, to make their trading even better. So I think, no, you don't really need to know it to start with, but it's, if you want to persist in this, I think it's almost impossible not to learn trading, or not to learn programming and statistics and machine learning.
Very well explained. I mean, to stay relevant and competitive, you need to always have edge over others, right? Who are competing against you. And
Yep.
even given you are experienced trader, but the other competitive traders, if they have edge over you, that is technology, then they definitely they can compete very well against you. So might as well, if you are interested in it, it's your bread and butter, you would want to prepare yourself for this changing market and the way it is evolving. So
I
that's a
I
wonderful
think,
explanation.
can I just say something? I think
Sure.
that an economic edge or a market edge completely outstrips an edge in your programming and math skills. I think if you have an economic edge, that's far better than being good at stats or maths. So that's my personal opinion. You know.
Yes, definitely. And if you already have that knowledge of markets, and if you top it up with the knowledge that you can get in programming or any other statistical modeling, or applying ML or AI, I think that can be something that can give you top-notch results. Okay, all right. So very well said. Now the next question. I'm a bit confused. So I'm going to talk about courses and learning materials, how we can learn these skills at the later part, so that right now we can address the core of it. Now next question is by Farooq. Now I also had this question. So I'm combining these two. So does AI requires new type of risk management or risk control for algo trading firms or individuals for that matter?
Um, Farooq, that's a really good question, actually. Now, actually, I don't necessarily think that AI requires a new type of risk control. I mean, there's a few there's a few nuances in that. One of the problems is if you use literally deep learning and you can't explain your returns, whether they're positive or negative, that works fine, especially if you trade other people's money. So you know your hedge fund, and you've got, let's just say, some people with 15-20 million dollars that invested their money in your fund, and then you got an AI and it makes excellent returns, 20% a year, whatever. That's all good and well, but then you have a year where you lose 15%. and then people come to you, they descend on you like hawks, and go, hey, what did you do? You know, and you're like, well, I'm really sorry, but that's just my algorithm doing it. They're probably gonna withdraw their money and shut you down before you can even, you know, get out of your chair. And so in a way, that's actually a really big problem. Even if you have a good algorithm, if you can't explain how it came to the conclusions it did, it could really give you a lot of problems. So that's one thing. Now the other thing is that because of all these machine learning algorithms now being deployed in the market, the the way we look at risk and how we deal with risk and how we treat risk is definitely different. So I think it's not so much that using an AI itself needs a new risk control, I mean, apart from what I just explained, because it's nothing other than an algorithm. And if you actually look, for example, when you use factor models in the market, right? Factor models are not exactly machine learning, but are very, very close in the way they are structured to machine learning. So there's a very, very small transition between when you use a factor model and then you actually go and use some other machine learning tools. So the risk control or the risk management is still more or less the same, but what has definitely changed, and actually my company, we're working also on those new ways of managing risk. For example, one of the things that really has come up in the last year or so, which has become really popular, is, on the last 2 years, is hedging tail risk, hedging you know, like a large correction events and so on, because we find that, you know, with the markets traditionally that was somehow managed by a 60-40 portfolio or risk parity portfolio with stocks and bonds and all that. But those things it looks like after we had a 40-year bull run in stocks and bonds, it seems that we're really coming to an end of that, and there needs to be new ways of managing risk, and that could also be a result of machine learning itself or of the way those tools are deployed in the market. So we need to really reconsider what we do with that, and I'm definitely quite strongly involved in that as well. And of course, that itself involves a lot of machine learning. So yes, I do think that there's going to be completely new ways to look at risk. They're not necessarily a result out of exactly what we're doing on our own desks, but they're definitely a result of where the world is moving or where finance is moving, for sure.
All right. So the risk management is one of the applications. Obviously, there is risk management of the machine learning models that you have, and then you also use machine learning to manage your risk as well. So
Yeah.
on the application side of it, I have a question. So that is, what are the most prominent applications of AI or ML models in various stages of trading, and which are the most common or popular ones? Uh,
Mm.
so if you could guide us on that.
Well, they're kind of everywhere, right? So I mean, if you you know, there's always these really funky examples where you know just to produce feature sets and input signals, you know, people use AI. You know, when you know those famous examples when satellites took images of the I think it was JP Sears, some US department store, not JP, or not JP Sears, JP. Oh no, that's someone else. That's a guy on YouTube. No, but Sears, like the department stores. And they looked at the decline of the cars in the car parks in front of this department. Oh no, it was JC Penney. That's it, not Sears. JC Penney. So they looked at the decline of cars in department stores, and they analyzed it with AI, and they found that, you know, as the cars declined, there was a really strong correlation to the price of their stocks, and they could really predict the demise of JCPenney quite confidently. And you know, that's a typical example of an input signal. Or another one is the one where, you know, satellites measured or looked at the shadows on oil tanks or on top of oil tanks, and they could actually see how far the lids were in, and so they could see what the oil inventory was. And oil inventory is extremely closely related to the oil price, and so knowing the actual inventory before everyone else gives you quite a strong edge. And so again, machine learning was used to analyze those images. So that's on the signal side. And then of course, we have then the signal processing side, where we can use AI, where we, for example, use or use machine learning, where we can use, for example, principal component analysis to reduce the dimensionality of our inputs and make the inputs a little bit more make them more orthogonal, so independent of each other. Then we can use algorithms for determining which input signals should be traded on. Just the one that we commonly understand as typical trading algorithms. And then on the next level, we've got, as you already mentioned, algorithms for risk management. So Marcos Lopez de Prado has a few interesting examples in his book, where he talks about how we can use some machine learning to manage portfolio risk, which is arguably superior to portfolio risk, classical calculations like the mean variance portfolio and all the permutations of the mean variance portfolio. So that's definitely something. And then moving even further, we've got execution. And again, in execution, you can use machine learning as well. Now, it's a little bit different in execution because you usually have to be very fast. So it's generally not that straightforward to apply machine learning in execution, because it definitely has a speed component to it. But you can see more and more that there is smart algorithms managing execution, like managing order routing. You've got these smart algorithms for liquidation, like similar to, say, implementation shortfalls and so on, that really work on achieving the best execution prices for you. So there's really machine learning in every step of the way down the track, and it always depends a bit on your trading style as well. But you could almost find algorithms for everything. But again, like, you can't just go and build an algorithm that covers everything. That's impossible. Again, machine learning is a tool, and it can be used here and there and here and there. But you need to know your tools, and you need to be aware that one algorithm might work for something and another for this. So, I mean, clearly, for the signal production, all this image recognition or looking at sentiment signals and so on, you clearly need deep learning, neural networks. And then for the more sort of trading style algorithm, it's actually generally better to use something that doesn't quite overfit. So you've got obviously linear models like linear regression and principal component analysis, but also something like support vector machines. They don't overfit too much. Whereas if you use decision trees, they can be really quite dangerous, because they can really fit a lot of the noise, and then you miss the signal. So you gotta be really careful with that type. But and then when it comes to execution, there's things that are really simple but quite fast. And again, linear models are probably quite important here. But also, I mean, reinforcement learning in the purest sense, it has been used for execution. So that's something that is interesting in the execution process, but it's still all a little bit in its infancy. So, that's gonna be a while. I mean, the most popular machine learning algorithm, nevertheless, is still linear regression, you know, and then perhaps logistic regression, and then maybe followed by PCA. Then I would say, yeah, decision trees or XGBoost and all these, they're kind of next. And then, you know, deep learning, reinforcement learning, obviously is still there, but it's not, I think, that much used directly for trading.
Thank you so much for such comprehensive explanation about all these applications and software models. So the next question I have is from YouTube. So on YouTube, Ram asks, I am algo trader from last 7 years, stocks to crypto. It was easy to scale once we got one system that worked, but the rewards slows down the learning. How one can grow out of such situation and go to the new tech?
So I didn't quite get the one in the middle. What slows down the learning?
Rewards, reward. So I think he's
Oh,
talking
okay,
about
okay.
results.
Oh, you know, so basically what hey, hi Ram, by the way, hello. Um, so what he's really saying is that as he actually does really well, he's kind of a bit lazy to learn. Is that the case?
Uh, that can be the case, but I think this is about the model that he has developed.
Oh,
So as it starts to scale, the learning of that model slows down, and eventually,
oh,
there is this. Basically, it saturates, and then if you really want to grow on top of that with the help of new tech, how can you go about it? I think that is the question.
oh, I see, I see. Yeah, well, I mean, that's a difficult one to answer because there's just so many possible there's so many possible answers to that. I mean, to be honest, personally, I, I never really rest on anything that works. I'm just like tirelessly like working on new stuff all the time. Always looking for a new way of building something and so on. And most of the time, stuff doesn't work, and you know, then occasionally you find some nuggets and something interesting. But what I would say to Ram, obviously I don't know your system, so it's a bit hard to answer that question. But to me, what I think that a lot of people often are lacking a bit is really good risk management. And one of the things that you can do is if you manage your risk more correctly, then you're in a position to really increase your geometric returns, first of all. So if you you know, if your drawdown sizes go down and so on, that means, you know, it's when I say risk, I don't mean just the risk as a measure of standard deviation, but risk can be expressed in many ways. Like, for example, what's your maximum drawdown and so on. And if you start actually, you know, looking at those different ways of managing your risk, what that also means is if you have that better under control, you can then really start to level up your strategies much more and actually make you know, make more money, or you could, for example, replicate your strategy in other markets and then use the risk management to control all the different strategies that you have. And I think, you know, risk is generally very underrated, and having a really, like, I mean, you know, even like that's what I found. Good risk management systems can produce alpha in and of themselves. So if you build a good system that manages your risk, you know, like a good hedging algorithm or something, those algorithms can actually produce alpha. So when you look, like, most strategies out there in the wild that exist these days, they're all what you would class as short volatility. You know, when you go long a stock, you're actually short volatility because, you know, normally if the volatility spikes up, the price of the stock will tank. And virtually all the strategies that are out there are short volatility. But one of the things that people don't really consider is that there is actually a bunch of interesting long volatility strategies out there as well, which we could use to really buffer and hedge the risk of our short volatility strategies, which we all have. And they can add a huge amount of juice to our strategies and actually really jack up our alpha quite significantly. So, I mean, not knowing more about your stuff, Ram, maybe that's worth looking into this a little bit.
Thanks for such a detailed explanation. And let's also answer the assumption that we have had initially. What if he's actually talking about, once he develops a strategy and money keeps on coming in, and then he doesn't learn new things? What to do in that case? Like how to motivate yourself? You mentioned about you being continuously researching for stuff and developing something new. So how to go about that? How to get that motivation?
Yeah, I mean, I've always got I mean, my I guess my personal I guess how do you say that character? There's two things are quite dominant. One is a real sense of curiosity, but another one is being completely freaked out by risk and being quite risk averse. So you know, whenever I have any strategy running, I'm always assuming that it's gonna get into a black swan and tank miserably. And never mind. But because of that, I always go like, oh, you know, how can this be diversified? How can this be better managed? How can the risk be mitigated for even like those little drawdowns and so on? And so, I mean, it depends. Like it's easy to get a level of complacency in the market when things are going well, and sometimes when things are not going well, it's actually quite helpful because it makes you really reconsider things. And I mean, you know, overall, there's always going to be the point where things do not go all that well, and that's normally the tipping point where you start to like really learn new things. But if you know, if you feel, oh, you know, I wanna motivate myself. I mean, yeah, curiosity is, I think, my main driver. You know, even as a physicist, when all those quantum computing things came along, I was like, how can this be used for trading? You know, and I looked into this quite a bit, and it's quite interesting. And then, you know, when there's some new machine learning coming out, I usually just sit down and code something up. Or specifically with strategies, whenever I see a new strategy that looks mildly interesting on some blog, I straight away I sit down and I code it up. And the other thing I do always is I never use trading platforms. So I avoid out of the box trading platforms. I always code up my strategies from scratch, every single one. I always start like with import, blah, 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 or depends on what I program it in. But if it's Python, you know, I literally start with import numpy SMP and I code it up from scratch. And what that does is it gives you also a huge learning advantage because you get really, really good and fast in coding up all types of strategies. And that can help really, you know, whenever you come across something new, rather than having to work out, oh, when can I fit it in? When can I start building it? You just sit down and you do it really fast and just see like the initial results and see whether there's something in it or not. And that can be super helpful.
That is really helpful. I mean, it also gave me some motivation. So definitely. So I hope that answers your question, Ram. All right. Now talking about learning and developing stuff. But yeah, before we move again on learning aspect of it, there is a personal question to you, which is specific to trading, asked by Anand. So Anand asks, is your belief in time-based price movement or price-based market movement?
Okay, I need to think about it. Time-based price movement or
Yes,
price-based market movement?
market
Okay.
movement.
Um, to some extent, I mean, in my just like understanding it straight away, I would say, well, that more or less the same things, but I'm sure you had something in mind that you think, and I'm not 100% sure whether I get that as well.
Right.
So I mean um I'm not sure I will be able to answer your question directly, but um one thing I can say, and maybe that answers your question at least to some extent. Um, so time-based price movements, oftentimes, we could see them as a sort of something that we can solve with just like say mathematical things like calculating indicators and so on. Whereas price-based market movements are much more determined by the underlying economics of the market. And one thing that I really drill into my guys all the time is don't try to beat the markets with mathematics. It's whilst it's probably possible, the chances that you succeed in that are far less likely than actually looking at the underlying economics of a trading strategy and why the trading strategy, or what is the economic edge that your trading strategy provides, rather than just trying to find some mathematical formula that quote unquote solves the market. I mean, clearly they do exist, but ultimately, I think there's always got to be some sort of underlying economic reasoning for why a strategy should work. And so, coming back to Arne's question, when when I look at the strategy, I'm much more always leaning towards strategies that have some sort of base in the markets or in the economy, in some underlying economic principle, rather than just pure mathematical formulations. And quite honestly, like when I see those, I generally don't trust them. Even if they look good, I often don't even consider them, because I'm like, it's too much maths. It's just, but there's no reason why it should work, and that always freaks me out a little bit when I can't see the reason why this should work, when it just works because it does. So yes, so coming back to that question, I think I tend to more lean towards the second part, the market movements and the economics of it, rather than just the analytics of a time series from a purely mathematical standpoint. I hope that will answer your question. I'm not sure, but yeah, fingers crossed it helps you a little bit.
I guess it answers that question. I mean, you explained it pretty well about the time-based price movement, which is just the numbers based on some time series, whereas there is a substantial data and substantial thing going behind price-based market movements.
Mm.
So I think that answers questions. I hope, Anand, that answers your question. All right, now moving on to the next question. Uh, and that is all right. So this one is about learning. So 𝗨𝗀𝗀𝗃𝗃 asks, are there any relevant books to read for a complete beginner to combine AI with quantitative models into financial markets? Uh,
Um,
I think you already talked about Professor Dr. Prado's book. So probably,
mm.
yeah, please
So
feel free to
obviously,
suggest the books.
I'm well. I'm probably not too up to date with books, to be honest. But one of the, and it also depends on sort of what level you're at. But I would say that um, Marcos Lopez de Prado's book is definitely giving a good general insight into where machine learning could be applied in many in trading. But I mean, there's a few other books in my opinion there that are really relevant, and probably my favorite is by Grinold and Kahn, Active Portfolio Management, and it's 700 pages of a lot of equations and so on. I mean, I went through the whole book, and it's not uh, specifically machine learning, but really the underlying principles are very, very close to machine learning. And I think if you have understood the underlying principles of that, you will be much, much better equipped to actually go and apply machine learning to your systems. Why? Because when you deal with a factor model, you need to really look into the same kind of principles that apply to machine learning, because for example, you need to check whether the factors that you input are highly correlated, and if so, you probably want to weight them a bit different, or you want to throw them out. You want to make sure, you want to see, well, what factors do I actually put in, and how do I measure or how do I measure what a good factor actually is, and how do I determine the outcome, and so on. Because one thing that most people actually overlook is how do you determine what is a good trading strategy? And you know what, that, like, most people say, well, it's the one that makes me the most money, but that's absolute and utter rubbish. It's not like that at all, because even like you could have a trading strategy that maximizes your geometric returns, but actually introduces a volatility that is just like about 2 orders of magnitude larger than anyone could stomach. And it's there's actually a really good book by a guy called Ralph Vince called The Mathematics of Portfolio Management. I think it's called like that. And he worked with some of the top traders in the world at the time, and he actually managed to support a guy who became at that year futures trading world champion. And they put on a strategy which was it returned phenomenally, like I don't know, was it like 9,000% or something? But it had literally swings of hundreds of percent. Like the volatility of that strategy was absolutely enormous. And so, of course, in the end, like, they made a lot of money out of that strategy, but it's probably only because they used a relatively, disposable bankroll. They just put in $10,000 or so, and then so it's probably very small number compared to what they had, and so they could just go all in on the risk. But on the other end of the spectrum, right, you have, if you manage other people's money, you want to make sure that you're really risk averse, and you really don't lose, you've got a big responsibility. You don't lose other people's money. And so this is really like a crucial part of what strategy are we actually choosing out of the universe of all different strategies that are making money. Not all of them are equal, right? Some of them are much, much better than others, and it's not strictly obvious which ones they are. And to be honest, the Sharpe ratio, for example, doesn't cut it in that regard. There's a lot more that needs to be considered. And that there's just a whole lot of variables to consider in this. And I think, interestingly, there isn't really an awful lot of books written about this, but one of the or some of the really nice books that I know that have been talking about this are by Mr. Trend following Andreas Klenov. Oh man, how he's a friend of mine. How could I? When you when you're sometimes talking, you go, oh. Yeah. So Andreas Klenov wrote a few good books that give you, especially the one on trend following. It's a classic, right? And it gives you a really, really good idea about, like, this, also not just the the ideas of trading, but the psychology whilst it's happening, and so on. And I think, in terms of books, this is really important stuff to learn. And when you understand this very well, it's going to be much easier for you to then go and deploy your machine learning algorithms as well, rather than just getting really good at machine learning. I don't think this is going to cut it. I think there's a lot more to it than that. So I would recommend reading a few of those trading books. Like they're really helpful. And obviously 𝗍𝗀𝗀𝗃𝗀𝗀 books have a lot of merit too.
Thanks for suggesting these recommendations. So, all right. So, moving on to the next question. So, we have what I think 5-10 minutes left. So, I'll pick last 2-3 questions maybe.
Sure.
So, quickly we'll go through some of these questions. So, some of them I see are on a personal level, but the one that is interesting and a much broader one that I can find is how AI or ML capture behavioral finance.
Okay. Well, I think one of the differences between classical trading and machine learning is probably, specifically if you use anything other than linear regression or linear models, that you capture nonlinear effects. And we know that behavioral model or behavioral systems are inherently nonlinear. So the famous example is have you heard of the Keynesian beauty contest? So the Keynesian beauty contest is interesting. This was actually developed by John Maynard Keynes, or the idea. And it's basically you have a beauty pageant where you have a number of beautiful women or whatever on stage. Maybe that's not so politically correct anymore these days, I'm not sure. And then everyone in the audience has to determine who they think is the most attractive. And so if that's the case, we get a really nice distribution, and you see, oh yeah, there's a strong consensus who's the most attractive, and then that drops off until you get to the least attractive, let's say. And if you split the audience into two parts, you will probably find that both of those split audiences again show a similar distribution of who is the most beautiful and so on. But now here comes the interesting part. You tell the audience not to actually determine who they think is the most attractive, but who they think everyone else thinks is the most attractive. And so you, instead of saying, oh, I think this woman is the most attractive, or this man, or whatever, I think, oh, who do I think everyone else thinks is that? And suddenly you get to this incredibly non-linear, chaotic outcomes. And you could split the audience again, and you get two completely different, crazy outcomes, completely different from what was before. And that, in a sense, is part. I mean, it's part of behavioral methods, and the outcomes become extremely nonlinear. And a different word for nonlinear dynamics is chaos in scientific terms. So machine learning can, under some circumstances, capture those nonlinear dynamics. It's quite difficult, even for machine learning as we know it, but it's technically and theoretically able to do that, unlike linear regression, which is completely unable to do it. So I think that this is where there is an interface between behavioral and behavioral occurrences, or behavioral finance and AI machine learning, is in capturing those nonlinearities that may occur and actually figuring them out, even without knowing exactly what the behavioral aspects of them are that are sitting behind them. However, you should know a little bit. As I said, it's always good to have an economic reasoning behind what you're doing. Hope that answers the question.
Thank you, Rajesh, for asking this very interesting question, and I hope you got the answer. So, all right, now two more questions. So, this one is on a personal note. So, someone has just heard you, and now there is an interpretation that, given your opinion on economics above maths, I suppose all your strategies include some sort of fundamental data and not only price data.
No, not really. Actually, that's not that's not really the case. I mean, they can, like, and also fundamental data, they can trickle in various forms, right? For example, if you you might actually select a specific portfolio out of a universe, and then you trade that portfolio, just that portfolio. So the fundamental data came in at the selection of the portfolio, but then you trade it on other things. But there's certain very specific effects in the market that you can exploit. They're not necessarily fundamental, but I remember when I was in India a couple of years ago, I ran some trading workshops there, and then I was told by the Indians that you're not allowed to hold short positions overnight. I'm not sure if that's still the case or not, but just purely knowing that people have to close out their short positions overnight, that in itself is an economic principle, and that can really lead to some really interesting market inefficiencies. So it doesn't have to be a fundamental data or anything. It could be something like this, or it could be something like every second, or every ever so often you probably heard of the term triple witching or quadruple witching, where all the futures and option contracts all expire at the same day. That happens like every 3 months, I think, or every 6 months. And so those dates, for example, that they have definitely a big significance for this, and they're not in that sense fundamental. And there's lots of these little effects. There's effects. Or you most likely heard that for many years, for 20 years, gold was always appreciating overnight, but during the daytime it was actually losing money. And so for 20 years you could just put on a long position on close and close it on the open, and you had like a massive upward curve, upward P&L. If you did it the other way, you started trading in the open and then closed at the close, you were flat or even downhill. And so there are economic things that arise from whatever economy. In this case, it's probably illegal market manipulation, but that's another story. But if you it's not just fundamentals. That there's many other effects in the market that could be interesting. Hope that helps.
Yes, so I hope that answers your question, Gustav. Now, all right, so the last question that I have for you is, do you, so now this one is asked by Manogan Ramallah. He asks, do you plan on collaborating with Quantra for another AI course in future?
Thank you. I'm not sure actually. What I found is it's definitely for me, being a busy guy that has business to run. I love doing it, and it's always also a challenge to produce the content. So I'm always trying, and I think I would love to one day, sooner or later. We haven't got any plans yet, but there's definitely scope for it, and hopefully maybe sooner or later that would be great. I would be very open for people giving me some ideas what actually they would be interested in. Maybe we can do something that overlaps with my area of expertise, and then maybe we can do it. Unfortunately, unlike, for example, my friend Andreas Klenov, who writes books like in lightning speed, I'm a bit slower, unfortunately. So it always takes me a bit more time. Yeah, so no plans right now. But if anyone has some good ideas, I would be very open, and maybe if you can let me know. You find me on LinkedIn, Dr. Tom Starke. Just send me a quick message and say, hey, how about this? And I would definitely be interested and take that into account. So thanks for that.
Thanks, Dr. Stark. So, for those of you who are not aware, so we already have a course along with Dr. Stark that is on deep reinforcement learning in trading. So, you can check out that on Contra. And yeah, so now I think we are going to close on a philosophical question. All right. So, and that question is asked by Satwik. Now, initially, Dr. Stark, you talked about your dream that never got materialized. Of
Yes.
So why does that happen with everyone in the life? If you could help us with that.
Oh, could you repeat this? I just didn't
So
quite understand.
basically, yeah. So Satwik says, why the dream never gets materialized? And initially,
Oh,
you talked about your dream.
all right. Well. I mean,
Yeah, that's a
okay, okay,
philosophical question.
okay. It's actually a really interesting question because I'm asking myself these questions all the time. Now, I can tell you, I can actually give you a really definite answer for myself. Now, I had this, when I started, I worked in a job, engineering. I worked in a great company, but it wasn't like my thing, and I'm actually not really cut out to be a sort of little cog in a big machine. And so I left that, and the dream was really a dream because I just didn't have any better ideas. But what I realized is this dream, like it's somewhat achievable. I mean, it's not like I could probably at some point do this quite easily. I live anyway close to the beach, so it's not a big deal. But what I realized is this is really not my dream life. I realized this was just like a dream because I thought, oh yeah, but my dream life is much more that I'm first of all I'm running my own business. I'm self-directed, and I can be creative and still make money. And if I don't want to get up in the morning, sometimes not very often, but sometimes I just stay in bed, and no one tells me what to do. So I'm self-directed, and I can still do the things that I'm really curious about and really interested, and I can always potentially use them to actually make a living and make an income for myself and for other people. And to be honest, that comes much closer to my actual dream. To be honest, my dream is now, after that dream faded, is that I actually never want to retire. I want to do this until the end of my life, until I drop dead, because I love it so much. So that's my philosophy now. I just love doing things. I love exploring things, and so that, like, lying by the beach is great, but I don't think I would get so bored with it very quickly. It's not a dream of mine anymore. So yeah, so here's my philosophy.
Wow. Thank you so much, Dr. Stark, for taking out your time. And it's, I
Sure.
think, more over 8 there in Sydney, right? So thank you for staying late, and uh, it's always a pleasure to host you on
Thanks for
these
having me.
webinars. Yeah, thank you.
All right, have a really good one. Good luck to everyone, and hope to see you again. Bye.
Bye. And okay, so now to all our attendees, just wanted to highlight that all the contra courses that we have are right now available at flat 75% off. And this is a limited time offer that we are running for Algo Trading Week. So I'll request you to make the most of it. And if you have any doubts, any questions, just go to this chat that you see here, and yeah, that's about it. So have a good day ahead, and I'll see you tomorrow. So tomorrow is going to be our last session on, and that is going to be on applying machine learning in trading, and I'll catch you in that one. Okay. Till then, take care. Bye bye. Thank you.